I'm going to share my screen and and just do the intro as I always do. Dawn Doherty here, Dan Gasparini. We are Options for Wealth. We are Options for Wealth. And oh, it's so nice to be leading a tribe of traders and investors who want to take advantage of volatile markets, who want to become self-sufficient in the way they invest. I believe we're living in a world right now where it makes sense to manage your own finances, right? The old days of relying on a financial planner, relying on a broker are over. We have tools that allow us to find opportunities, I think in a more powerful way than most brokers have access to, because they're just towing the company line. There's so many brilliant people out there who have created some amazing tools, and we're going to look at one today, Market Chameleon. And Dan, little different for me today. I'm sort of like going with the flow today. I'm not. Do you still see my screen?
I see your screen. Yeah, it's up.
Profitable trades. Okay. Yeah, I'm kind of going with the flow today as opposed to having something totally prepared. And I'd love to get some feedback from you all who are with us on ways you want us to look. Last week, we introduced a tool, just real easy on options. You can buy calls or puts. You can sell calls or puts, and Dan's going to review with you, how to go bullish, bearish, and neutral. What I love about options is rather than what most people do with ETFs and stocks, most people go directional. With options, we can identify where we believe the stock or ETF or index won't go, right? With what we do with condors and other strategies. Legal as always. Dan and I are not licensed financial professionals, okay? There is risk in the market. We love options because we believe when you understand how to trade and invest using options, there's a whole lot less risk than with what most people do. But if you doubt anything that we're sharing with you today, we ask that you seek the advice from an independent financial advisor, okay? Dan, would you say we're still in uncertain times?
Yeah, no, absolutely. I don't even think that the long-term effects of COVID and the changes that have been made are baked into anything yet. But volatility, as you were speaking to, is opportunity when it comes to what we're doing here. We like uncertain times when we're trading options, and we'll speak to that a little bit later. But
yeah, uncertain times is an options trader's best friend, right? So the statement that I love to read every week, let's take what this market is giving us. Remember, no position is safe in this environment, and the strategy is to take profits. Be an assassin, hit and run. And some people say, well, if I do that, my taxes are going to be up. And here's the thing, paying taxes, that's a good problem. That means you're making money. But a wonderful thing also is you can use these strategies within your IRA, and you're not paying taxes within your IRA. The government is giving you, get out of jail free card saying, go crazy in that IRA, turn up your profits. You don't have to worry about that. Movers, we were looking at movers that are related to COVID, but what I'm going to just go over and do right now, Dan, is take people over. And I haven't even looked at what Market Chameleon is showing us today, but I'm going to take everybody over to the tool that we look at and that our tribe looks at, called Market Chameleon. And I'm going to stop share. I'm going to start share. And let's take a look at what the markets are showing us. Okay, so we got some trade ideas on the left. Right, Zoom is up 6% today. what we love doing is going to the top here and clicking on options and then clicking on unusual, love that word, unusual option, volume. And we go down to this chart and we click on volume, right? And we see what the options gods are giving us today to look at. So it's not a surprise that Zoom is up there, and how interesting, we have 50% on the calls and 50% on the puts. So how would you read this, Dan?
I would read that as a very even spread on calls and puts, right? I mean, that means that for all out of the money trades on calls and puts, it's a fairly even skew. What this doesn't speak to is how close to the money the demand for calls and puts are. But if you were to, for example, compare and contrast that to the line below, 90% and 10% on an MGM, that is quite a bit different, right? You know, what that is saying is the market is factoring in large short-term gains for MGM.
For MGM, yeah, and that may be something that we take a look at. Let's take a look at that with you today, okay?
And 50, it almost means like the jury is out where the next move is going to be.
On Zoom, right? But you could see here, and you know, we're looking at large trades made by institutions, and if we drill down on MGM, for example, right, we would get some more information on specific trades, right? That were being made, strike prices, right? So there's a lot going on this 20 strike for MGM. MGM, right, is at 20.07 right now. So we could drill down and we can create trades based on where we see real time movement. And that's why I love this tool. It's free. Yes, there's a paid version of it, but for the most part, what we're being offered on the free side gives us a lot of ideas around what to look at. So just wanted to show you that, and maybe Dan, I could hand it over to you maybe before what you go into. You could pull up in Thinkorswim what the chart of MGM looks like, and maybe we can right here on the fly create a trade around MGM, and I promise whatever we create, I'm going to take right now because I believe in us.
We can do
I
that.
believe in us. Let's do that. Let's create a trade around MGM. And those of you who are with us, you can trade with us or just watch the progress of what we put on. But I'm taking this. I'm on my other computer here live while we go through this.
I'll pull something up and we can take a look again. You know, trading under the gun here, but that's okay. Works out a lot of the time. Okay, sorry,
I'm a risk taker. I'm a smart risk taker.
Well,
I like rolling the dice.
MGM is for you then. Can you, it's not letting me share.
Oh, you know what? I have to go back to you. Oh, you should allow. Okay, let's see.
I think I joined as a participant and a host.
Oh, you are a panelist though. You are a panelist. It should allow you to share.
I was updating the trade log that we have there. One of my trades closed today for profit, so that's nice. MCY, remember that old trade, the MCY?
Oh yeah. So how did you do on that?
Yeah, $2,500. You know, it's a longer
Amazing.
term, but that's a nice little.
Yeah, thank you, Joel.
Yeah.
Solomon on that one. Remember?
Yeah.
Yeah, but you know, it's tell people about that. What prompted you to look into that? And yeah. But you should be able to share now. You are a panelist.
Host disabled participant screen share. I think you have to make me a host if you go to. I mean, it shows me as a panelist right here.
Make co-host. All right. Make co-host.
All right. There we go.
Okay. Cool.
We'll talk about butterflies in a second, but this. You want to do the MGM one first? Or you want to go?
Yeah. Let's take a look at that.
Let's look at MGM.
Okay.
So, you know, as you guys probably all know, you know, MGM, big entertainment and casino brand. Nobody's been gathering in large groups, you know, given the state of the union, but it seems to be that MGM is recovering in a way, right? So we've seen MGM fall from
Higher lows and higher highs, right?
Yeah, like so it fell from 36 down to 5.9 dollars a share, 5.90 a share, and we're seeing the old staircase on the way up, right? We're looking at higher lows, right? Low. See how we had a correction here down to another low, another low. I mean, kind of broke the trend here, but it is trending fairly strongly to the upside right now, right? Which is understandable why people are buying calls and not puts on this stock. If we were going to draw a
Fibonacci retracement,
we would go to the wick of the high.
36.22. Okay, so we're very close to the 2106 there, maybe breaking through that 2106.
Yeah, that tells us to be wary, right, of this area here, right? These lines represent areas of consolidation and either flattening out or sideways movement typically. Now, not all the time, but looking at something like this, being that we're at 20 right now and we're very close to this 2106, and also noticing just from a technical analysis point, looking at this area here, right? Noticing how there seems to be some orders held up there that are just sitting there.
So this may be something we pass on right here, or potentially short-term bearish.
Yeah, we can even go the other way on it. I mean, this is a 4-hour chart, so I think this is more of one to keep an eye on and maybe do maybe a bear put spread, if anything, if we wanted to go short-ish term. Let me go to June 19th. And then it becomes a question of, okay, how big of a pullback? How big of a pullback do you think there's going to be? If you think there's just going to be a small, I don't think there's going to be a massive pullback just because it's trending so strong to the upside. But if we did a, say, maybe a 2-point pullback, what does that look like?
So when we're we're doing a bear put, so we're a net buyer, So that's what the green is all about, and we're paying 54 cents for each contract of MGM.
Yeah, to just speak to that really quickly. Again, this is not a trade recommendation.
No, we're just doing ideas. Which is on the fly, ideas on the fly, which are so much fun.
This is going to be, for those of you who are joining us for the first time, or maybe only the second or third time, this takes a while to ingrain, right? I know Britt has been with us now for a couple months. She's wrapped her head around this, but this, what I'm showing right here, this quadrant is the foundation of it all, right? Understanding what price action I need on the underlying, given what options position I have taken. And you see here I have 4 options positions laid out. And as complicated as options can be, you can make it fairly simple and just analyzing the fact that there's really only 4 moves you can make, trading options. You have calls and puts. You can either buy them or sell them. So that gives us only four outlooks we can take. If we're not messing with expiry dates or anything like that, we're saying, if we're buying calls, we want the stock to go up. If we're selling calls, we want the stock to go down. If we're buying puts, we want the stock to go down. And if we're selling puts, we want the stock to go up. And in this position that I have outlined here, we are a net buyer of puts. Okay, we're buying the 19 put, and we're selling the 17 put just to lower our cost basis a little bit. Okay, remember, if we just were buying the 19 put, this would cost us 85 cents. We're recouping a bit of that by selling the 17 against it. And what this position is saying is that we are anticipating price falling below 19, right? My put here, below 19 on or before June 19th of this month. So back to the chart. What's the price action chart kind of theory that we're looking at? We're thinking it's going to trickle up here, hit this, 21 or so area, and then fall down to maybe down to about here. Anywhere below 17 would represent our max profit on our end. And 17 is located again at this smaller, shorter term support area. Kind of see it in there.
Right. So what you're saying is, if we were to trade this anticipating that it would go below 17 in the short term, then we'd be profitable.
Yeah, and the other thing too is this is a good one to like keep loaded and almost in the chamber, and maybe put the order in for, instead of 54 cents, right? Since we're buying this, we want it to be as low as possible. Mm-hmm. And we do think price is going to continue to trickle up until we hit that Fibonacci level. So, I mean, I would almost put this in at like maybe 35 cents.
Uh-huh. And if you get filled, we're not spending a lot of money here.
Good till cancel. Leave it in there. And then if you can get filled on that, then you're looking at a better percentage-wise return, right? So assuming we can get filled at 35, right? Current price is at 20. Price moves to 21, this play becomes cheaper to enter. So assuming we can get it at 35, we do 10 contracts, which means our max risk on this trade is 35 times 100, because there's 100 shares per contract, times 10, because we're doing 10 contracts. So 35 times 100 times 10, $350.
$350, big whoop.
Yeah, and our max reward is $1,650 net of our, that's net after what we've paid. Okay. Mm-hmm. Now that doesn't mean that it has to go below 17 for us to be profitable. In fact, we're profitable as price falls. Mm-hmm. At expiry, we just need to be below 1865 to be profitable in this trade. Yeah. So max risk 350, max profit 1650. Profitability point at expiry, remember expiry is June 19th, is 1865 or below. And if anyone asks us questions, feel free to put them in the chat. I know, Don, you're monitoring Facebook chat, but I'm going to pause there for a second, take a big swig of my coffee. And then I'm
going to get on Facebook and take a look at the chat also. So those of you who are with us right now, please, in the chat box. And I know some of you have no mic or webcam. That's okay. There is a chat box. And those of you on Facebook, please let us know if there's anything you'd like Dan to answer or anything else you'd like to look at. Dan, yesterday I shared with the group, what I like adding. Britt says, oh, I get it. I kept thinking I had to go below the second red line at expiry. Right? So maybe you could explain what she's speaking about here. Yeah. So Dan is coffeeing up right now.
Yeah.
So that's what we need to keep Dan in coffee. I don't know what it is about options guys, but they love their coffee.
It's more of a need thing, I think, at this point than love. I passed love a while ago. Now it's just I'm completely useless if I haven't had a couple coffees.
You're useless without your coffee. No, I don't believe that.
Yeah, the second, I kept thinking I had to go below the second red line at expiry. Yeah, so this line here, right? This red line here, that's the break-even point. The two red lines are, the break-even point currently well, this purple line break even point is tied to, you know, whatever date you have in here. So yeah, that will be current. And then at expiry would be the blue line, right? So this red dash across the blue line, anything below 1865 would be the break even at expiry, June 19th. So let's talk about this trade, other trade I put on that just closed this morning.
Your MCY.
MCY. So insurance company, not going to go into the whole plethora of reasons why we got into this trade, but we got into this trade into March.
We got into this trade, and I did not follow you on this one. I wish I did.
Yeah.
In March, we were looking at what's going on with insurance companies, and yeah, a whole lot less cars on the road. They're still collecting premiums, even if some of them are giving little, you know, breaks or rebates. They're doing well because there are less accidents, you know, from a theoretical, right? If we're looking at it, less accidents.
Yeah, like a balance sheet type of approach. Yeah, they're still collecting and they're not paying out as much.
Right.
And so this was in March that we put this on. So we were in this for a while. This is much longer than I'm typically in the trade, but you know, I'm going to show you the trade that we put on. And then what I like about this trade too is we squeezed every extra penny we possibly could out of this trade. So again, I'm going to speak to that.
Okay.
I don't want that pointer. So the price was somewhere in here when we entered. I think the current price was like 37 or 36.
Right.
It was, we bought the 40 calls. We bought the 40 calls for June 19th expiry. 2 months away, bought the calls at 40. Okay. Price, and so those calls cost, I gotta get my notes. But the dollar cost average for those worked out to be, because I bought a few of them here. Price went down a little bit. I bought a few more. The dollar cost average on those calls was $1.30. Okay.
So,
and I bought 15. I bought 15.
15. So 15 times 100 times $1.30 was your max loss, right? Because we're buying calls, and that's the most we could lose.
Yeah. So 1950. Okay.
Okay.
1950, right? Max cost.
$1,950.
We then, so this was in March, April, right? And so then what we did was we sold 15 once price started to trickle up a little bit here. Okay. Price started to trickle up a bit, 38 or so. We sold 15 of the May 45 calls against this. So 15 of the May expiry, right, calls at 45. So up here, right, above 40.
Mm-hmm.
And we sold those for, again, I have to look 4 different places to see exactly where we sold them for 75 cents. This is incorrect because the dollar cost averaged it down.
Okay. So you bought.
Oh wait, that's right close to that. So originally I bought the calls at 272, and then MCY took tanked, and then I bought more of the calls at like super cheap, like maybe 50 cents. So I ended up dollar cost averaging down to 130.
Okay.
I sold the 45s at 75 cents. And what that did was it just gave me an extra, right, 75 cents, right, times 100, times 15, So that gave me an extra $1,125 on this trade, right? By turning this into, we did a class on diagonals a couple weeks ago, but I've effectively turned this into a diagonal via selling the 45s. This would be a good one. You know, I covered this actually with Britt a little bit, but we'll cover this again and again because, you know, there are still some really good opportunities for diagonals. Think of it as I'm taking a long position on a stock. I think the stock is going to go up, but I'm going to recoup my costs along the way. That's essentially the theory behind a diagonal. So I sold the 75s against it. I sold the 45s against it for 75. So that gave me an extra just $1,125 just in the bank, in the trade. Mm-hmm. Then today came. These expired worthless, obviously, so I collected full premium on the 75 cents, right? And the 272, which a dollar cost averaged down to 130, right, sold just this morning because I had a good till cancel stop at 245.
Wow.
So my net in here is.
So you almost doubled.
Yeah, this should have been 130.
Right.
This is 15 at 245. You know, my realized fee after commissions and all that is 1,750 less commissions, so 1,733. What I
yeah, commission. What are the commissions? $1 a contract each way, or less than that?
Pretty reasonable. I think all in for the entire trade was like $17. Mm-hmm. And so the sum of those two numbers, even though today my account only reflects, you know, $1,733 gain, right, on this trade, I collected the other 1,100, you know, a couple weeks ago. So net on the trade for a $1,950 investment, we made $2,858.
Pretty nice. And that percentage is what?
146.5% return.
Say that again, 146%. So this is why options are so exciting. This is why options are so exciting. Yes, you know, on the less exciting side of options, although it's still very, very exciting, you know, I shared with the group that I added to my portfolio yesterday. I bought 1,000 shares of TWTR, Twitter. And I did a covered call play, right? So I sold calls, and that was very profitable decision, up close to $800 in one day. It's more of a longer term opportunity, right? Because if that stock gets called away from me and I continue to keep it in my portfolio, I can be juicing up my rate of return on the long term. So, you know, there are two sides to what we're doing here. We're doing short-term trading for income, and we're also looking at how can I maximize my long-term gain through bringing in underlyings and that I believe in, and turning up the rate of return with selling calls against, you know, every 100 shares I have.
Yeah, it's all about, right? It's all about doing every component of it, right? This is a holistic thing, options trading, right? So on the wealth side, it's just as important as on the income side doing this. And, you know, look, if we don't take this extra step here, instead of 146, we're making 88%, still very good. But point being, squeeze that extra out of it. And that's exactly what the whole point of a covered call portfolio is, right, Don? Is you're going to go long the underlying anyway. Squeeze that extra percent and a half out of your underlying every month or two.
Every month. Yeah, and during more volatile times, I can choose to buy some insurance to protect the downside, and be paid to buy insurance, and that's what I love.
Yeah, that was, we entered this one on 318 and then added on 417, just for those wondering.
Thank you, thank you, thank you.
Cool. Did you want to go over the covered call stuff, Don?
Yeah. Oh, no. Why don't you do, I'm not going to go through that today. Why don't we do
Talk about
what
this
you were
one.
planning to do on the butterfly and
Yeah.
talk about this new way of us looking at short-term trading using the strategy of a butterfly, using
Sure.
the SPX, which is the S&P 500 index. And Dan, I just want to thank you, because your brilliance was behind me making an extra $6,500 last week.
Yeah, that was a nice Friday surprise. Last week we put on a butterfly similar to this one. I'm going to go through in a second. I believe it was $1,500, give or take, maybe $1,500 to $1,700 to put on, net of
Right.
5 contracts.
Yeah, we bought at $3.20 a contract
Yeah, on a Wednesday.
on a Wednesday with an expiration on a Friday.
And yeah, Friday we both were able to get out. I let mine ride to expiry. Don got out at the last minute. Both turned out to be profitable, and it was roughly like a 400% return, right? Something like that.
Crazy. Yeah, well, think about it.
500,
6,700 over whatever it was, 1,600. So crazy. 400. It was 405%.
Yeah. So I haven't added that to the tracker yet, but I will make sure. I'll put like stars around that one. That's I think the biggest winner to date.
Yeah, and here's the
last
thing.
2 months. We've been doing this for about 2 months. I think that was the biggest winner so far.
It's incredible. And this is why we do it. I'm going to get a little philosophical here. I was reading the New York Times on Sunday, and there was an article about a woman complaining, and this was a healthy, intelligent 30-year-old woman saying, "Oh, I'm so scared because my unemployment's running out in July and I may not have a job after that. And where's the next incentive check?" And my mantra is stop whining and start winning. And how do you start winning? By learning a new strategy. So those of you who are watching this Facebook, watching this recording with us here, those of you who are live with us, I want to commend you. I want to acknowledge you for taking the first step, which is opening your mind to a new way of bringing in some more money monthly, so you don't have to rely on the government, so you don't have to rely on something that doesn't feel good for you. That's why we do what we do.
We were talking about this, I think it was yesterday or the day before, Don, the streams of income, right? Multiple streams of income. I don't claim to be a finance coach by any stretch. That's Don's domain. But, one thing I absolutely passionate about is you need to have multiple legs under that table. The more legs you have, the safer you are. When you lose your job, great. You have 3 other streams of income coming in. This can be one of them. It doesn't have to be the biggest one, right? And furthermore, you work so hard for your money. People in general work so hard for their money, and then they just give it to somebody else to deal with because they've made it, right? It's
right,
like,
because they say, "Oh, I don't understand all that stuff. I don't have time to look at all that stuff." I've had people say that to me. I'm like, okay, so you.
It's like you work 50 hours a week, but you don't have an hour and a half a week to manage all the money you got. Anyway, we digress. That's our. We digress.
That's our public announcement, public service announcement of the day.
So this was the takeaway for me for butterflies in the last, and this is only, something that I've come to in the last, couple of weeks. Historically, this was a play, a butterfly, and just really quick, what a butterfly is. We're going to go out of the money on one side, and we're going to guess it's a directional play for the most part. In this case, we're going to say, I think the price is going to go up, or I think price is going to go down. Or I think price is going to go up. This is my butterfly will look like this. Current price, we're going to buy a call. We're going to sell 2 calls in the middle point of the butterfly, and then buy another call back. I'm not going to go in like massive detail in the construction of the butterfly right now, but just really quickly so you understand what it is. It's 4 legs that appear as 3 legs on an options trade because the middle leg is doubled up. There's a bull call spread mashed together with a bear call spread, point being the center strike. Okay, so this is what we've done here. For the people that aren't following that, this is what you can really make sense of really easily. It's going to create a shape like this. That's why it's called a butterfly. It's kind of like a butterfly, I guess, or a tent. We're profitable at expiry if price is within our tent. Okay, I'm putting a tent somewhere. We got to have price in there at expiry. And this is something that I used to do in 2016, like often. Like these butterfly plays. You guys remember 2016? Price was just kind of like chugging to the upside, chugging along, chugging along, chugging along. It wasn't like massive swings, but it was just kind of like chugging along the upside, right? And so these plays, what we would do was we would go out 3 weeks, 4 weeks, put our tent somewhere. We would call it a time bomb butterfly because eventually price would just kind of keep chugging along and it would end up in that butterfly and we'd be good. But we had to do them 21, 28, 30 plus days out because they were so expensive because the market was much more predictable. Now, for better or for worse, the markets are much less predictable. And that effect that is having on the price of these things is that they're much lower. So that presents us the opportunity to do them much shorter term. Entry on a Monday, exit on a Friday type of short term. And enter on a Wednesday, exit next Wednesday, short term. This one, for example, we entered on Tuesday with an expiry date of Friday. This would not even be in the realm of possible to do in 2016 because it would be way too expensive. It wouldn't make sense from a risk reward stance at all. Now it does. That goes back to the point of being adaptable. You have to continue to adapt with markets because they change. What worked on, we were doing a series of strategies in 2017, early 2018, that worked tremendously. They do not work at all right now. We were doing double calendars.
We were doing double calendars. And the reason, we had the VIX at the level, 11, 12. Today, when I look at, where we are with the VIX, although, we were as high as 80 at one point, we're at 26.
Yeah, like it's just, we've normalized to a higher daily swing in the markets is essentially what's happened. We normalized to there being more movement. If in the past, the S&P 500 SPX index moved an average of 8 to 10 points a day, now it's moving an average of 15 to 20 points a day. Give it like the average, right? Today, what are we up today? 30 points almost. Like that used to be a massive day.
We're up, the SPX today, we're up 35 points. So imagine, if I bought a futures contract at the beginning of the market, I'd be making $50 times 35 today, which is a crazy day trade opportunity. And we're not even, halfway through the day here in the market.
Yeah, I mean, like we used to, there would be a day like this every 2 months, 2.5 months.
And like, this is like
a
normal day today.
Times a week right now. So anyway, so this is the butterfly we put on yesterday, okay? I did 10 contracts this time. 3080, 3100, 3120. So what I'm saying is on Friday at expiry, that price is between 3080 and 3120. And price
we're close to 3120 right now at 3116.
Yeah, so this is a delayed dummy account, but let's say we're 3113.88, give or take. What we need is, right, for price to settle down a little bit now through the end of the week. As we move forward in time, let's say Friday, if we're right where we are right now on Friday, this trade will make $3,500. Okay. But it'd be a little nicer if we had a little more wiggle room and pulled back a little bit.
Oh yeah.
And
what was that number? Can I see that number again? 16,000. Yeah.
It'd be nice if we got 16,000 out of this. To give perspective, last week we ended up relatively right about here on the butterfly. We did less contracts, but we weren't on the point, but we were like close to the point.
Yeah, we were really close to the point because we were 6 points away or something like that.
Yeah, so we're 6 points away.
We
right
closed at like 30.44 and our midpoint was 30.50.
So it comes to the point now where, and this is the downside of doing such short-term options trades, is that how do I adjust this? Like, what am I going to do with this? Is this an all-in trade? Am I just in or out? And sometimes the answer is yeah. I mean, that's the trade-off of doing these so short-term, is that for a lot of it, you're just in or out. Like, there's not really an adjustment that can be made here for the most part. Like, if we were sitting out here at, 31.40, you're out of the trade. You're done. You can exit out of it. You can, take your $600 licks and move on. We, however, are right on the edge of this butterfly. Obviously, seeing more damage, I guess, or risk to the upside. And so one of the things we can do, and one of the things I was just kind of modeling now, was is adding another butterfly above.
Okay.
And this is what that looks like.
Yeah, show us.
That this doesn't, it gives me, essentially what I'm doing when I'm doing this is saying, okay, I am no longer holding this to expiry. I am exiting at the beginning of the day Friday or the end of the day Thursday, and taking advantage of, maybe a $1,500-ish type of gain. Okay, rather than I'm foregoing the big winner. I'm saying, all right, I'm gonna take advantage of just this bigger curve here. By the numbers, this is why this idea works by the numbers. So today we have a negative delta, significantly negative delta, negative 25, meaning for every dollar price goes up from here, we're going to lose $25, $26. Every dollar price goes up with the underlying. Okay. However, our theta is massive. The benefit of doing these short-term butterflies is you have a massive theta as long as you're in the 10. Theta is your time value. For all else being equal, I'm going to gain $330 today.
For every day that goes by.
Yeah. I'm going to gain $330 today. I'm going to gain $611 tomorrow. And I'm going to gain $1,400 the next day if price stays where it is. Okay? Mm-hmm. And so what we're doing, right, by adding this portion, notice here also that I have 10 contracts on my original butterfly and only 5 on the other one. Okay. By adding this other portion, we are seeking to manipulate our theta and our delta simultaneously. In doing that, we've lowered our delta, which is good, right? Our delta, well, technically we've increased our delta, but we've lowered the amount negative it is. Okay. And we've increased our theta. And the reason why this becomes a good adjustment, we're looking at this number here and this number here. Oh, and this number here.
Oh, yeah, okay.
And the reason why this is a favorable adjustment is because with this stroke of the pen, I guess you could say, we're fixing 2 problems. We're at least nerfing 2 different problems that we have. Like this is too high. This is too negative, I should say, right? Mm-hmm. And we want this to be as high as possible.
Okay.
Right.
So I'm not losing so much when price goes up or down, and I'm gaining more with every day that goes by.
We're giving it, hold on a second. We're giving it some more wiggle room, right? What we're saying, yeah. Instead of price having to be, between, realistically between about 30.70 and 31.20. Realistically, instead of our range being this, our range is being this.
Okay.
To the increase in the range.
So you're going to move forward and do this. You're thinking of doing this.
I'm looking at it. So I'm awaiting for the market to pull back a little bit more. I think you're going to get a little bit more of a pullback, and then once this gets a bit cheaper, I'm seriously considering. I will post this if I put it on. It's
Yeah,
just,
and when Dan says post, he means, you know, to our group. So for those of you who are with us, and if you want to watch us trade and invest, if you want to take our ideas and practice them on a paper account, you know, which is really a simulated way of getting more confident around options, you have an opportunity to do that by joining our tribe. And, you know, we have a membership fee that is one, you know, is probably 1/20th of what it is that we're doing on a monthly basis in terms of our profitability. We don't profit all the time, but what's great about options is we can look at the percentage of probability that we profit on every trade. And it's the smart person's way of trading, and we just love it. We're passionate about it. If you want to join us, Dan, I'll just put on the screen here what that can be like for anybody who wants to join us. We have an unbelievable group of heart-centered, determined, eager, purpose-driven people. Britt's on our call with us today. You know, most of our people do work full-time jobs, so sometimes they can't get on this particular call, but they watch it at the end of the day. And what's so great about options is you're not tied to your computer all day long, right? So, and then when you couple that with getting WhatsApp alerts from us, you can do the adjustments like Dan spoke of. You can place the trades. Once a month I lead a covered call, all-in call the Thursday before the third Friday of the month, where I show you what my portfolio adjustments look like and how I'm turning up the rate of return in my portfolio. So, oops, I don't know what happened there. Let me go back here. Let me just go back here. So immediate trade ideas through the text group. We have a Monday roll up your sleeves learning intensive where we interact. We go through the nuts and bolts of options 101, and it's our intent in, you know, less than 5 months for you to have that options brain click in where you understand this fully. And I'm so happy I'm there. And give it time. Showing up like you're showing up today is step one. And our students choose to do some one-on-one with you as well. We have an online portal to access world-class training. We also have vetted resources that we share with our team. So that's how you get in on the action. And I am Dawn at Options for Wealth. Dan is Dan at Options for Wealth. You're welcome to reach out to us. And if you want to have a conversation, we'll just schedule a time with you. Dan, anything else you want to say before?
Yeah, just that. And I know I've said this before, but, you know, from personal experience, doing this about 10 years now, trading options, it's really hard to figure out on your own. Truly, like you really, it's just, your learning curve plateaus so quickly if you're just trying to figure this out. And sometimes you just need someone to hold your hand and say, hey, click here, don't click there. This is why this, or this is why that. And that's what we do. We hold your hand, give you ideas, we trade them live, you know, with the group, and we discuss it. Like, for better or for worse, we'll discuss, you know, what happened on a given trade, and it just adds to that learning, and, you know, really increases your learning curve. Really flattens your learning curve. Flatten the curve, right?
Yeah, further faster, because we're human beings, and here's the thing: we have an attention span that's less than a goldfish. So. I think it's something, our attention span is 7 seconds and the goldfish attention span is 8 seconds. So if you can connect to someone or a group that will get you further faster, will allow you to have all of this click in record time, then you're going to stay with it, because you're going to see your bank account go up and you're going to feel confident around your portfolio. You know, when February was happening, I made a stand and I said, I'm not going to wish and hope that it comes back. And yeah, okay, we're up again, and who knows, you know, where my previous portfolio would have been, but I restructured my portfolio during this time using options, and I feel so empowered. I feel like, wow, you know, whatever happens in the market, I'm going to have a steady rate of return on a monthly basis. And that's what I'm all about, right? I could speculate on my income account, but I'm not speculating in my IRA. And if your IRA is filled with stocks, if your IRA is filled with mutual funds, if you're not implementing a covered call strategy, if you're not considering buying insurance to protect your assets, that's called speculation. And most people in this country are speculating as it relates to the stock market. And that's why, they saw those double-digit drops. And I want to sleep at night. So we invite you to get smart with us. We invite you to meet some awesome people. Dawn at Options for Wealth, Dan at Options for Wealth. So over and out. We do this every Wednesday. So happy to be with you this morning. And we'll see you soon.
See you next Wednesday.
Yes. A new message. Thank you. Thank you, everyone.